Hello everyone. In this video we're going to work through the Chapter 13 notes. Chapter 13 was titled Differential Analysis, the Key to Decision Making. One thing I like about the material in this chapter is a lot of these decision-making contexts apply both in and outside accounting. So a pretty practical use for a lot of these things. Just something to think about as we get going. So our first learning objective was to identify relevant and irrelevant costs and benefits in any particular decision. So a few key concepts for us to consider as we get started in thinking about these various decision-making contexts. Every decision really involves picking from at least two alternatives. Otherwise, there wouldn't be a decision to be made. So the first step in decision-making is to define the alternatives or the courses of actions that are being considered. Once we've defined alternatives, we need to identify some set of criteria for picking amongst them. So in this particular chapter, we're going to focus on this idea of relevance primarily. So relevant costs and relevant benefits should be considered when making decisions. Irrelevant costs and irrelevant benefits should be ignored when making decisions. Let's talk a little more about what relevance should mean for us from a managerial accounting perspective. So the key to effective decision making is differential analysis, which is just focusing on future costs and benefits that differ between two or more of the alternatives we're considering at the time. Everything else then we'd say is irrelevant and should be ignored. So relevance for us is really going to hinge around this idea of differential future costs and benefits. If things are different between the alternatives we're being considered, then we'll consider it relevant. If they're not different, if they're the same across two or more of the alternatives, then we'll consider them irrelevant and say that we should ignore them. So a few more terms for us to consider. A differential cost is a future cost that just differs, as the name implies, between any two of our alternatives. We can extend that to this idea of differential revenue. Same thing, except we're referring to revenue that differs between the alternatives rather than a particular cost. A little more specifically, or at a different level of analysis, we'd define an incremental cost as a differential cost that's increasing between two alternatives. And then an avoidable cost is any cost that can be eliminated by picking one alternative over another. And this idea of avoidability is really going to become critical in determining whether things are again, relevant or irrelevant from a decision-making context. A couple of terms that we introduced way back in Chapter 1 will also come back around and be useful here in Chapter 12. And the first is sunk costs. So sunk costs, as we may recall, are any costs that have already been incurred in the past. They can't be changed regardless of anything that we decide to do in the future. So from a decision-making standpoint, those should always be irrelevant when picking among alternatives. Now, there's a demonstrated psychological effect that you may have heard of called the sunk cost fallacy. It's really hard for people from a cognitive standpoint to ignore money they've spent on things or costs that have been incurred to get something up and running. So oftentimes managers fall victim to this sunk cost fallacy and sort of throw good money after bad money. So in our context here, we want to make sure we're focused on this idea that sunk costs really are entirely sunk. We can't do anything to change them in the future, so they shouldn't weigh into our decision. Future costs and benefits that don't differ between alternatives, again, we'll consider those entirely irrelevant to the decision-making process. And that second term to bring back around from Chapter 1 is opportunity cost. So opportunity costs are potential benefits that we're going to give up or forego when we pick one alternative over another. So in the context of our make or buy scenarios that we'll talk about in a little while, sometimes there are opportunity costs of continuing to make something in-house, in that we're using up space and capital resources that could be freed up to do other things if we purchase something from an outside supplier. That's just one quick example that you may have read about already in Chapter 12 to kind of bring this idea of opportunity costs around. So let's try a practice question here. Sunk costs are blank relevant in decision making, while variable costs are blank relevant, and fixed costs are blank relevant. Give that one a quick thought as far as relevance and cost behavior goes, and then come back for the answer. So the best answer there is B. Sunk costs are never relevant in decision making. Variable costs are sometimes relevant. Fixed costs are sometimes relevant. The point we want to make there with variable costs and fixed costs is we can't make a blanket statement about any relation between cost behavior, meaning variable, fixed, and mixed, and this idea of relevance. The point about relevance is a cost is considered relevant to the decision-making context if it differs between two alternatives. So that could be true of some fixed costs, it could be true of some variable costs, but the point is there's no guaranteed relation between those ideas. So let's consider another quick example here, identifying relevant costs. Cynthia here is a Boston student. She's considering visiting her friend in New York. She can drive or take the train. By car, it's 230 miles to her friend's apartment. She's trying to decide which alternative is best. So what are some relevant costs she may consider in this decision? Give this a quick pause and a thought, and then we'll come back and talk about potential things to consider. So there's a few things that jump out. Right? We're either taking the train or driving to New York from Boston. So the cost of the train ticket would differ between the alternatives and would be considered relevant. If we take the train, we buy a ticket. If we drive, we don't buy a train ticket. Similarly, the cost of gas, maintenance, depreciation on the car, all those types of things, those are certainly relevant costs as well. If we take the train, we don't have to deal with that stuff. If we drive, we do have to deal with it. When we get to New York, we'd have things like parking also, if we're driving ourselves, whereas if we take the train, we don't. So there's other things that would come about too in terms of like time maybe that could be quantified, but some of the sort of more obvious examples are the things that I've just mentioned here. Let's try another ECO then. Which of the following would be relevant in the decision to sell or throw out obsolete inventory? The first cost, the direct materials cost already assigned to the inventory. And then the second, the cost of disposal of the inventory. So whatever we have to pay to get rid of it if we're throwing it out. Give that a pause and a thought, and then come back for the answer. Best answer there is C. So the direct materials cost already assigned to the inventory, those are not relevant in this decision. That's a good example of a sunk cost. Everything's already been incurred from a materials standpoint in getting this inventory to us and stocked in the warehouse, so that's not relevant. But the cost of disposal of the inventory is. If we sell it, we're presumably having no cost of disposal and hopefully getting some money in return. If we dispose of it, we throw it out, we're going to have some kind of dumping cost, landfill cost, whatever. So again, anything that's different between the two alternatives would be considered relevant. Anything that's not different would be irrelevant. Let's shift gears then and talk about some different approaches to decision making that we're going to make use of throughout Chapter 12. So your textbook talked about the total cost approach and the differential cost approach. So let's start with the total cost approach and think about how we'd set up a problem in that type of analysis and what we might learn from it. So let's assume for a second that the management of a particular company considering a new labor-saving machine that rents for $3,000 a year. Here's some data about the company's annual sales and costs with and without the new machine. So we can see the current situation on the far left here, their expected sales, their variable costs, their fixed expenses currently, and then their net operating income. We also see the situation with the new machine added to it, so nothing changed sort of in the sales range. We did have a particular change in the variable cost in that direct labor has been decreased by adding this machine. However, that is followed with an increase in fixed expenses from renting that new machine. So the projection there is that the net operating income would go to $30,000. So if we're using a total cost approach to trying to make this decision, that's exactly what we would lay out side by side. We want to make sure we'd have all the information for the current situation as is, and then all that information regardless of parts that are repeated for the new situation. When we make that comparison, we can see that net operating income we would expect to increase by $12,000 if we rent this new labor-saving machine. In other words, the savings from the lower labor cost more than offsets the increase in fixed cost from renting that new machine. Again, assuming our projections about sales staying the same and all those types of things are true. We can also see here laid on the far right the differential costs and benefits of the two scenarios. So that really helps us isolate the change in labor and the corresponding change in that rent on the new machine and what those things combined do to net operating income. So really, if we take this differential cost approach, we can be a little bit more efficient in our analysis, just looking at the two specific items that change rather than looking at everything that doesn't change as well. So we're just focusing on, well, what happens to labor costs? Those decrease by $15,000. What happens to fixed expenses? Those increase by $3,000. So the overall potential advantage of renting that new machine is $12,000. That's the same difference we would come up with if we use this total cost approach, but again, we're potentially simplifying the analysis by just focusing on the components that have changed, the differential cost, aka the relevant cost in this scenario. So using the differential approach is desirable for at least two reasons. It is possible we won't have enough information to be able to put together detailed income statements for both alternatives under the total cost approach. We might only know sort of things that are guaranteed to change. In this scenario, the projected labor savings and the cost of renting the machine. Maybe we're a little unsure on some of the items that make up our income statement and how those might change. Second, if we mix and mingle irrelevant costs with relevant costs, we might cause confusion, which is sort of the extreme end of the things, or at least distract attention away from information that's really critical. So if we can help managers out in terms of focusing their attention on the things that are most critical to the decision, we might, as an organization, put ourselves in a position to have managers making better decisions. Moving on then, our second learning objective was to prepare an analysis showing whether a product line or segment should be added or dropped. So we had talked about some considerations related to this back in Chapter 6 when we looked at segment reporting and how our segment margin was a pretty good measure of potential profitability of any segment. So we're going to consider similar things in Chapter 12 here. So our decision rule around adding or dropping segments is pretty simple. A segment should be dropped only if the overall profit for the company would increase. And so only if that segment or product line is taking something away from the combined bottom line of the company rather than adding something to it. So we'd say that a firm could compare the overall contribution margin that would be lost if a particular line was discontinued to the fixed expenses that could be avoided, avoiding being the key word there, if the line was discontinued. So let's use an example here. Let's look at the segment income statement for a particular company's watches segment. So they've got sales of $500,000, contribution margin of $300,000. Got a whole bunch of fixed expenses shown here that result in a net operating loss at the segment level of $100,000. An investigation, though, has revealed that the fixed general factory overhead and the fixed general admin expenses would not be affected by dropping the digital watch line. So in other words, those fixed expenses would just have to be reallocated to other product lines or dumped on other segments. So that was the general factory overhead again of $60,000 and then the general admin expenses of $30,000. The equipment used to manufacture the watches, we also know, has no particular resale value or alternative use. So the depreciation associated with that is not going to be changed if we get rid of this watch line then. So the question becomes, should the firm retain or drop that watch segment? So we can really start with the contribution margin for that segment. We'd be losing as a company $300,000 in contribution margin if the watch line was dropped. And so that's just the $300,000 CM currently shown on that segment's income statement. However, there are some fixed costs that could be avoided if we do drop that product line. the salary of the line manager, so presumably that individual is unfortunately out of a job, the direct fixed costs associated with advertising that product line, and then rent or factory space there where we produce the line and do all those types of activities. So we could free up or save $260,000 in total fixed costs if we drop that product line. So we are essentially comparing the contribution margin we'd lose from selling those watches to the fixed expenses we'd save from no longer producing them. And in this case, we see a financial disadvantage of dropping the product line in the amount of $40,000. So again, that relates to the fact that there were several fixed expenses that were unavoidable. The general factory overhead was just allocated to our different product lines. Depreciation amounted to a sunk cost, and then general admin expenses were similarly just allocated to product lines. So similar to our discussion in Chapter 6, sometimes our segment reporting can be potentially misleading if we don't account for the fact that some fixed expenses are traceable and avoidable and others are not. So the previous solution could also be obtained by putting together the comparative income statements showing results with and without the watch segment. That's more like our total cost approach from our first learning objective. So I just want to take a quick look at that to highlight the difference. Again, we'd be saying, well, if we keep the watches, we had this net operating loss in the segment of $100,000. If we drop the watches, we're losing all the sales, all the variable expenses as well, but the total contribution margin of $300,000. General factory overhead remained. Remember, that was just allocated to our different product lines. Salary of the product line manager disappears. That's avoidable. Depreciation is not. And it's essentially a sunk cost, so it becomes irrelevant to our decision. The general admin expenses also remained. So we can see that the total bottom line picture after we've dropped the watches is really a $140,000 loss, if you will, in the segment compared to the current $100,000 loss shown on paper. And that's the same difference of $40,000 we found just a minute ago. We just want to be aware that allocated fixed costs can distort our potential keep or drop decisions. And we alluded to that with the previous example several times. So including unavoidable common fixed costs can potentially make our product line appear unprofitable, when in fact dropping that product line would hurt our overall combined net operating income, as it did in this particular example. So usually these decisions do hinge on what portion of these fixed expenses are avoidable if we get rid of the particular segment, and what portion are not. What portion are just common allocated fixed expenses that would get dumped on somebody else but would still remain in the company's overall potential profitability calculation. Moving along then for the moment, learning objective 3 was to prepare a make or buy analysis. So when a company is involved in more than one activity in their entire value chain, we refer to that company as being more vertically integrated. So a decision to carry out one of the activities in that chain internally is just called a make or buy decision. So one example I tend to think of is automobiles again. So GM and Ford and Toyota and so on, they have a decision whether they want to make all of their component parts, everything from the engines, transmissions, and so on, down to even smaller component parts like navigation systems, electronics, and so on. So we would say that a company who makes all those things in-house is very vertically integrated, whereas one who outsources a lot of those functions and brings together component parts in their product is a lot less vertically integrated. So some potential advantages of vertical integration is that, again, in theory, we'd have a smoother flow of parts and materials. If we're not relying on someone else to supply certain things, then we should have a better idea of when we can deliver those components, and we should be able to put together a process that carries those materials through our production equipment in a more efficient manner. Second is quality control, and that's obviously a big one. If we're making something in-house, we are seeing the entire production process. We are watching it every day. We're seeing the inputs and outputs of it, and we have a tighter control over what comes out of it in terms of those parts. If we're outsourcing it, yeah, we've certainly probably done our homework to figure out, is the company reputable? Do they provide a high quality product on average? How do they set up their production facilities and so on? But we're not there every day monitoring what they're doing. In theory, then, these two things combined could potentially lead to better profitability. Again, from an efficiency standpoint and a quality control standpoint. Some potential disadvantages, though, is that companies might fail to take advantage of suppliers who can create economies of scale by pooling demand from a whole bunch of different companies. So to my automobile example, if GM and Ford and Toyota and Subaru and Volkswagen all want to buy a particular type of transmission, so an automatic transmission with the tap shift and whatnot, they might go to a company like ZF, who that's all they do is build transmissions for a whole bunch of different automobiles. ZF is going to have economies of scale because, again, that's their entire purpose for existence. They're only making transmissions. They can probably do it better, cheaper, and faster. However, while that is a potential factor that's appealing to firms, we also want to make sure we're careful to retain control over things that would be essential to maintaining competitive position. And that would relate most significantly to things like quality. So we think about luxury automobiles in my example, BMW, Mercedes, and so on. They'd certainly want to be careful that whoever they're buying their transmissions from, or their electronic components, or whatever piece of the car we're talking about, has the same quality standards that they themselves have. Otherwise, that's going to damage their brand if they start putting in subpar components to their automobiles. So let's talk about a make-or-buy decision. We'll use a little example here. Essex Company makes this Part 4A used in one of its products. The unit product cost right now is shown here. Direct materials of $9 a unit, labor of $5, variable overhead of $1, depreciation of special equipment of $3, the supervisor's salary and general factory overhead of $2 and $10 respectively, for a total unit product cost of $30. So we're going to talk about which of these costs sort of become relevant in this type of decision and which would be less relevant. So we also want to note the special equipment used to make this thing has no resale value. The total amount of general factory overhead would be unaffected by a make or buy decision, so it would just be reallocated somewhere else. The $30 unit product cost is based on 20,000 parts produced each year. And now an outside supplier comes along and says they'll supply 20,000 a year at a cost of $25. So should the company stop making Part 4A and buy it from the outside supplier? In other words, is this $25 per part actually cheaper than the $30 unit product cost that we're showing on paper now? So one thing we can do is, again, just lay this stuff side by side and think about what costs remain and what costs sort of go away. So if we buy this thing from the supplier, we were going to pay $25 a unit for 20,000 units, so a total of $500,000. If we make this thing, we've got the direct materials cost, that's entirely variable, so that would all remain. $9 times the 20,000 units, or 180,000. Labor, truly variable, so that all remains as well. Variable overhead, also by definition variable, so that stays. The depreciation of that specialized equipment, though, that's a sunk cost essentially. We're not getting rid of that in either scenario, so we can either include it in both sides, or we can just leave it out entirely. This isn't saying it's going away if we make it, it's saying it's no different whether we make or buy, just to be clear there. Supervisor's salary, that remains at $40,000 if we make it. If we buy it, though, that all goes away, of course. And then that allocated general factory overhead, similar to the depreciation. That's incurred regardless. It's just going to be dumped on somebody else. So we could either include it on both sides, or we could leave it out entirely. So the avoidable costs associated with making 4A are all those variable costs, and then the single avoidable fixed cost of the supervisor's salary. And when we look at that side by side, we can already see a pretty clear picture of what our decision would be. Even though on paper it looked like it would be cheaper to buy it from the outside supplier at first glance, because of the fact that some of these costs are unavoidable, it's actually cheaper for us to continue to make it in-house. And again, we said that the cost of that equipment was a good example of the sunk cost, and the allocated general factory overhead is remaining regardless, just being dumped on somebody else. So should we make or buy? Yeah, the financial advantage of making this thing in-house, just the difference between the buy side and the make side, or that $160,000. Here's a good chance for us to remind ourselves of potential opportunity costs involved in some of these decisions. So as we know from earlier study, opportunity costs are not actually expenses that we've paid out or are paying out anywhere. And so you're not going to see them recorded in the records of an organization. Opportunity cost is strictly the potential benefit that we give up by pursuing one course of action over another. So related to this make or buy decision, and this comes up fairly often, if the space that we're using to make this particular component part had some kind of alternative use, so maybe we could make a new product and we could sell it and generate some contribution margin from it, then the opportunity cost would have been equal to the segment margin that could have been derived from the alternative use of that space. And that would have potentially changed our overall decision of whether the lower cost alternative was to continue to make this thing in-house or not. So let's try a practice problem here. It's not as bad as it looks. Ellie's a multi-product company that currently manufactures 30,000 units of this component part MR24. The facility is now being used to make it have a fixed monthly cost of $150,000 and a capacity to make 35,000 units a month. If we were to buy that part from an outside supplier, the facilities would be idle, so it would just be sitting there empty, not doing anything with it. But fixed costs would continue at 40% of their present amount. That was the $150,000. The variable production costs of the part are $11 per unit. If Ellie continues to use 30,000 units of part MR24 each month, it would realize a financial advantage by purchasing that from an outside supplier only if the supplier's unit price is less than what? So pause this, try to come up with a number there, and then come back for the answer. So our answer there is $14. Again, we can lay this out side by side if we'd like to kind of think about the difference. Under the make scenario, we had the fixed cost of $150,000. Under the buy scenario, 40% of those were remaining, so $60,000 in total. Under the make scenario, we had the $11 per unit variable cost of production times the 30,000 units, for 330,000 total dollars. There's a total of 480,000. So to figure out the sort of indifference point at which we'd want to buy from the outside supplier, we can take that total cost of making the component part, 480,000, minus the 60,000 in fixed cost that remained under the buy scenario for a difference of $420,000. If we divide that by the 30,000 units of the component part we need, that shows us that the indifference point is really the $14 per unit. In other words, if the supplier comes along and says they're going to charge us $15, then it's a no-go. But anything at $14 or lower, then yeah, it would be advantageous for us to buy it from the supplier rather than continuing to make it ourselves. Learning objective 4 was to look at our next decision context, which was whether or not to accept a special order. So a special order is really just a one-time order for our purposes that's not considered part of ongoing business of the company. So when we're thinking about whether or not to accept a special order, we again want to try to focus on the incremental costs and benefits of that special order. And since the existing fixed overhead costs would not typically be affected by any particular special order, we're going to generally consider those not relevant unless we have some reason to indicate that something's going to change related to that. So let's look at an example here. Jet Inc. makes a single product whose normal selling price is $20 a unit. A foreign distributor offers to buy 3,000 of those things, but at half price essentially, $10 per unit. So it's a one-time order that would not affect the company's regular business. So in other words, we want to make sure that the company isn't sort of poaching its own potential customers by selling to a reseller. Annual capacity is 10,000 units, but Jet's currently producing and selling only 5,000 units. So explicitly here we've got some excess capacity. We can fill some potential special orders, again, if they're beneficial to us from a bottom line standpoint. So should Jet accept the offer, we just want to consider whether that looks like it's a profitable endeavor. So here's our contribution format income statement before considering the special order. Right now we're making and selling 5,000 units of this product at $20 per unit, for a total of 100,000 in sales. We've got variable costs related to that single product at $8 per unit in total. Contribution margin was 60,000. We talked about fixed overhead. We also have some fixed marketing cost of $20,000. So net operating income for the company is $12,000. If Jet accepts a special order, the incremental revenue in this case will exceed incremental costs, and net income will increase by $6,000. So let's make sure we can derive that in just a couple short steps. The incremental revenue from selling 3,000 additional units to the wholesaler at $10 per unit is $30,000. The incremental cost is 3,000 units times that $8 variable cost of production for a total of $24,000. And so we'd say the financial advantage of accepting the order is the difference between those two, or $6,000. Again, we're assuming, and we can do this because we weren't told anything different, that all of those fixed costs of production are essentially unavoidable costs. They'd just be allocated regardless of the fact of what volume point we were at between 5 and 10,000 units. We're also assuming that there's no extra marketing cost incurred on this special order. So we did have some fixed marketing costs as a result of selling this product in general, but for the special order we weren't going to incur any additional marketing costs. So again, just boils down to incremental revenue versus incremental cost. Incremental revenue, the 3,000 units at $10. Incremental cost, just the variable cost of production then. Nothing fixed would change in any way, shape, or form. So Jet should accept that special order, all things equal. Let's look at another example here. So Lander Appliance makes and sells electric fans. They usually sell for $42. Here's some cost data per fan based on a full capacity of 150,000 fans being produced every period. Direct materials of $8 a unit, direct labor of $9, and overhead of $10, of which 70% is variable, so $7. 30% is unavoidable fixed. A special order has been received for 25,000 fans to some kind of overseas customer. The only selling cost that would be incurred would be $4 per fan for shipping. So Lander's now selling 120,000 fans through regular channels. So we've got some excess capacity. Assume direct labor is an avoidable cost in this decision. What should Lander use as a minimum selling price per fan in negotiating a price for this special order? So give that a pause and a quick try here, and then come back for the solution. The price there is $28. So to come up with that, we want to consider all the incremental cost of producing and selling these 25,000 fans to the overseas supplier. So we have the variable cost of production, the direct materials at $8, the direct labor at $9, and then the variable portion of the overhead at $7. That's a total of $24. We also have that incremental selling cost of $4 per unit for shipping. So in total then, 24 plus the 4 gives us a potential price or jumping off price at $28. In other words, if we sell it for less than that to the outside supplier, we're losing money on that special order. Anything at or above that, we're at least no worse off, and we would say all things equal, we would accept that. So we just have a couple more different decision types or contexts to think about, and the first is learning objective 5, determining the most profitable use of a constrained resource. So companies don't always have unlimited resources and unlimited capacity to make all the different products at the projected volumes they would want to. So in that case, they're forced to make some kind of volume trade-off decisions to figure out what they're going to spend their time making. In those situations, companies have to sacrifice production of products that in theory would be less profitable for the time spent making products that hopefully would be more profitable. So a couple of terms for us to think about as we discuss this type of decision context. With a limited resource of some type, any type really, so whether it's labor, machinery, even space in a production facility, when we have something like that that restricts our ability to satisfy demand in some way, we call that particular restriction a constraint. The machine or process or space requirement or whatever it may be that's limiting our overall output, we refer to as the bottleneck. That's just the point at which we're kind of restricting that flow of ideal or optimal production. So fixed costs are usually unaffected in these situations, so we're looking for the product mix, that's the relative portion in which we make and sell our products, that maximizes our overall total contribution margin. We should not necessarily be promoting those products that have the highest unit CMs, but those that have the highest contribution margin generated per unit of the limited resource. So if our limited resource is direct labor, like people touching things to put them together, then we want to make sure we're focused on producing the products that make the best use of that labor. They generate the highest contribution margin per labor hour, for example. So let's look at an example here. Ensign Company makes two products, and here's some data shown below for both those products. Product 1 and Product 2, which sell for $60 and $50 respectively. Product 1 has variable cost per unit of $36, Product 2 $35. So on a per unit of product basis, Product 1 has a CM of $24, Product 2 has a CM of $15. So right there we'd say, well, Product 1 so far looks like the most profitable of the two products. In terms of current demand per week, we can make and sell 2,000 units of Product 1, and we can sell 2,200 units of Product 2 at most. Their CM ratio is given at 40% and 30% respectively. We also know that Product 1 takes just 1 minute of processing time on this machine A1, and Product 2 only takes half a minute on that same machine. So machine A1, let's assume for a second that's the constrained resource, and it's being used at 100% of capacity. So that thing's always on, it's always running, always being used to make these products. So there's excess capacity on all other machines. A1 is the bottleneck, the constraint. Let's also assume that machine A1 has a capacity of 2,400 minutes per week. So that's the maximum amount of time we can be running products through that machine. And the question we want to answer is, should Ensign focus efforts on Product 1 or Product 2 given that constraint? So the key then, as we alluded to earlier, is which product generates a higher contribution margin per unit of the limited resource rather than per unit of the product. So if we take the contribution margin per unit of product for Product 1 and Product 2, and we divide by the time that's required on that machine A1 to produce 1 unit, we can see that Product 1 generates $24 in contribution margin per minute of machine time on A1. On the other hand, Product 2 generates $30 in CM per minute. Again, $15 divided by just the half minute it takes. So $30 per minute for every minute we spend making Product 2 on that machine A1. So the better use of the constrained resource, that bottleneck, the machine A1, is Product 2. So we should try to make and sell as many units of Product 2 as we possibly can, and then with whatever time is left, we should focus on making and selling Product 1. So we can maximize our contribution margin as a whole by again producing Product 2 to fill every bit of customer demand we have for that product, and then and only then using the leftover for Product 1, and we could come up with numbers for that as we kind of work through here. So our weekly demand, as you recall from a couple slides ago for Product 2, was 2,200 units. Those things take a half a minute each on that machine A1. So if we make the full demand of 2,200 units, fill all the customer demand, we would use up 1,100 minutes of processing time on A1. 2,200 units times that half a minute each. Then, with the remaining time, we'd have 1,300 minutes available. Okay, total time available on that machine was 2,400 minutes, minus the 1,100 we're using to make product 2, leaving us with 1,300 minutes to produce product 1. Since product 1 takes a minute for each unit of product on that machine A1, we can make 1,300 units of product 1 in that remaining time. So again, we're just trying to prioritize the use of this limited resource. Product 2 generates a higher CM per minute of time. So again, we'll fill all the demand we can with product 2 first. Then with that left over, we'll make as many units of product 1 as we can. If we do that, we can see that our total contribution margin would be calculated as such. Production and sales of product 1 was 1,300, product 2 was 2,200. CM per unit was $24 and $15 respectively. So there's our total CM based on product 1 sales and product 2 sales. And then the company as a whole would generate CM of $64,200, the sum of those two amounts. Let's try another one here. The Webster Corp makes 3 products with the following costs and selling prices. The company has insufficient capacity to fulfill all the demand for those products. If machine hours are the constraint, then the ranking of the products from most profitable to least profitable use of that constrained resource is what? So pause this, give it a try, and then come back for the solution. Again, machine hours are the constraint. So if machine hours are the constraint, the answer there is D. And how we can go about finding that is taking the contribution margin per unit of product divided by the machine hours required to produce 1 unit to find the CM per machine hour. So for product 1, that's the selling price of $21 minus the variable cost per unit of 11. So that in parentheses is our CM per unit, divided by the 0.2 hours it takes, and there's $50 per hour. Product 2, selling price minus variable cost, divided by the half minute it takes, and that generates just $10 per machine hour. And then product 3, selling price minus variable cost, divided by the 0.2 hours it takes, and that generates $70 per machine hour. So again, all things equal, we'd want to make sure we're filling all the demand for product 3 first, and then for product 1, and then for product 2 last with anything that may be left over. That'll maximize our overall profitability by making the most profitable use of our constrained resource. The other thing we might as well point out here is that this answer would potentially change if direct labor hours were the constraint instead, because those things use labor hours in differing proportions as they did with the machine hours. So we'd have to recalculate their contribution margin generated per labor hour in that case. Moving on to learning objective 6. Now we're going to determine the value of obtaining more of a particular constrained resource, just following on our previous analysis. So increasing the capacity of a constrained resource, all things equal, should lead to increased production, sales, and then profitability. So one question we'd want to be asking ourselves in these cases of constrained resources is how much should the company be willing to pay to acquire additional amounts of that resource if they even could. Okay, so earlier we said some of these constraints could be things like labor hours. Right? If that's the case, we'd say, well, we might be able to add some staff, some more people on the assembly line. How much should we be willing to pay them? Similarly, if we're talking about an automated process, maybe we can buy some new machinery. How much should we be willing to pay for that? So let's figure out how much Ensign, our previous example company, should be willing to pay for an additional minute of that processing time on machine A1 if it could go out and acquire more somehow. So the additional machine time would be used to make more units of product 1. Remember, that's because we had already filled all the demand that was out there for product 2. So all we could use that extra time for would be product 1. Product 1 had a contribution margin per minute of $24. So all things equal, Ensign should be willing to pay up to $24 per minute to acquire more time on that machinery. Again, we're not saying that this is something they could run out and do tomorrow and just flex that time, but if they could, that would be our initial determination of that particular decision. How much would we be willing to pay to potentially acquire new machinery? We could start by looking at how much we'd be willing to pay to acquire additional time on that machinery. Again, in this case, it's $24 per minute because that's what we could generate by making additional units in product 1 and filling that leftover customer demand. So there are a few more things for us to consider in terms of managing these potential constraints in our production process. It is fairly often possible for managers to increase capacity of these constraints or bottlenecks, and we just call that relaxing or elevating the constraint. So some ways we might be able to do that, and we alluded to some of these earlier, is working overtime on the bottleneck. So again, if it's just a matter of we don't have people working around the clock on this thing, maybe we can have them work overtime on that particular part of the process. Maybe we can subcontract some of the processing that would occur in and around that bottleneck. So maybe we have a machine shop on standby that can do some of the processing of our products for us. Maybe it's a little more expensive than we can do it in-house, but maybe it's still potentially profitable if we can fill customer demand. Third is potentially investing in additional machines at the bottleneck. Again, that's not a decision that's going to be a relatively small one, but we can start to think about what it does to profitability with some of the analyses we just completed. Where we said Ensign in our one example is willing to acquire additional time at $24 per minute. If they had a whole bunch of unfilled demand every month, it might end up being profitable for them to just buy an entirely new machine at that bottleneck. We may be able to rearrange or reallocate resources from processes that have excess capacity to ones that are bottlenecks. Maybe we have people who have idle time on another part of the process, and they can hop in and help out at a bottleneck. And then a couple more. First, focusing business process improvement efforts on the bottleneck. Maybe there's ways we can improve efficiency, and we should start any type of effort like that at the constraints or bottlenecks in our process, at those things that are sort of holding up the rest of the parts of the process. And then finally, reducing defective units processed through the bottleneck. That sort of fits with number 5 there. Ideally, we should be trying to ensure that our bottlenecks are the most efficient parts of the process, since they're already constraining our production. LO7 was our final decision context, so that's preparing an analysis showing whether joint products should be sold at this split-off point or processed further. So in some industries, a bunch of different products, known as joint products, come from a single raw material input. And the point in the process where these joint products can be sort of disentangled or recognized as separate products, we refer to as the split-off point. Sometimes we have an opportunity to sell things at a split-off point or do some kind of further processing to transform those things into different products. And we refer to a decision in and around that context as just a sell or process further decision. So one of the easiest examples to think about here is petroleum refining. So in this particular type of process, we've got a big joint input, right? That crude oil. There's some common production processes that happen with that, and out comes things like oil, gas, and household chemicals, right? They all come from that petroleum. In that setting, we incur some cost up to the split-off point when those things start to be able to be recognizable as different products. We refer to those as joint costs. Then again, sometimes these particular products that come out of that common process can either be sold right here after that split-off point, or maybe they can undergo some separate processing that leads to a new product that's the one that actually gets sold. If we have additional costs associated with that, we're just referring to those as separate product costs. And we're saying maybe this additional processing incurs some additional cost to get it ready for its final sale. Joint costs are traditionally allocated among the different products at split-off, and a lot of times that's done on the basis of relative sales value of the end products. So in our oil example, we're saying all these joint costs might be dumped on these particular products based on the relative value of oil, gas, and the household chemicals. Allocation, as we've talked about several times throughout the semester, is necessary for things like balance sheet inventory valuation, but it can often lead to suboptimal decisions. It can often make products and segments look potentially unprofitable when really they are profitable, because we're saddling these products or segments with costs that aren't necessarily driven or incurred by that particular product or segment. So joint costs are irrelevant in decisions regarding what to do with that thing after the split off point. So they shouldn't be allocated to end products for decision-making purposes. As far as considering whether to sell those things that split off or process them further, our decision point there will really just come down to another incremental revenue versus incremental cost analysis. In other words, does the incremental revenue we could potentially earn by transforming that product into some final product outweigh the incremental cost of doing that additional processing after the split off point? So let's look at an example here. Sawmill Inc. cuts of logs from which unfinished lumber and sawdust are the immediate joint products. Okay, that's what comes off at that split off point. Unfinished lumber is sold as is, or we can process that further into finished lumber. Sawdust can be sold as is as well to gardening wholesalers, or it can be processed further into presto logs, those fire starter logs that you see in big box and hardware stores. Here's some data about Sawmill's joint products. So the sales value at split off of the lumber is $140. That's the unfinished lumber. The sawdust is $40. After further processing, we can sell the finished lumber for $270 and the presto logs for $50. Here's some allocated joint product cost of $176 on the lumber and $24 on the sawdust. And then the cost of the further processing to go from unfinished to finished lumber is $50. And to go from sawdust to presto logs is $20. So we're going to try to decide, should we sell or process this stuff further? So let's start with the lumber. The sales value after that further processing, so turning the unfinished lumber into finished lumber, is $270. The sales value of the unfinished lumber at split off was $140. So the incremental revenue from that processing is $130. The cost of doing that finishing, though, or that additional processing, was only $50. So our potential financial advantage of doing the processing is $80. Okay? Assuming demand for all this stuff, we would, all things equal, like to be doing the further processing and selling finished lumber rather than selling unfinished lumber at the split off. Let's look at the sawdust potential product then instead. So that sales value after further processing the presto logs was $50. Sales value of the raw sawdust was $40, so we've got incremental revenue of just $10. And it would cost us $20 to do that processing, to turn the sawdust into the presto logs. So our potential financial disadvantage on that side is $10. So all things equal, and again assuming we have demand for those particular products, we would want to process the lumber further into finished lumber, and we would want to sell the sawdust at split off point as the raw sawdust. We would not want to process that into the presto logs. So to wrap this up, just a quick note about activity-based costing and relevant costs. Our ABC that we talked about in Chapter 7 can be used to identify potentially relevant costs for all these decision-making purposes. However, we have to be really careful there that we're not reading more into the traceability of ABC than really exists. Remember, under ABC, we were tracing as many possible costs to the individual products as we could. The only potential drawback when we think about how that relates to relevance is people have a tendency to kind of assume or get in this habit of thinking that if a cost is traceable to a segment, it's automatically avoidable. And that is not necessarily true. So traceability and avoidability are not synonymous. So before making any decision, we want to make sure we can determine which of our potentially relevant costs are actually avoidable and not just traceable. just something for us to think about as we tackle any of these particular decision contexts. So that's it for the discussion of our Chapter 13 notes. Feel free to try some practice problems, and we'll see you next time.